Hey, everybody, and welcome back to another episode. I'm your host, Brandon Cobb, and today I've got Guy Bouchard on the show. He is CEO and co-founder of Top Down Investments, private equity real estate company. He's also the founder of the Ultimate Real Estate Lifestyle, where he teaches how to actually reach financial independence. I am excited to jump in with him today because he's got a plethora of experience and he works with students to help them build a lifestyle that they actually want. The business is designed in order to create the lifestyle that they want. Guy, welcome to the show.
Thank you very much, Brandon. Glad to be here, buddy.
Why is it that you think most people fail at creating financial independence?
I love that question because I don't get it asked that much, but it's what drives me. Um, my belief is that, and my experience is that people just they don't really have a true understanding of what it means to invest into real estate. Just not having the experience or knowing what they're getting themselves into. Everyone has these expectations. Like we were just talking about, everybody wants financial freedom. Everybody wants passive income. Everybody wants cash flow. These are all buzzwords that get people excited about real estate. But the reality is, it's a lot of work and there's a lot of risk. And I think you can agree as operators when we look at the reality of what it takes to actually execute and achieve our goals and achieve the desired outcome of these results. It takes a lot of experience. It takes a lot of work. It takes a lot of planning. And there's a lot of things that can go wrong along the way. And so I've seen, especially in the last 5 years, a lot of people get into it for the right reasons and have the best intentions. But one deal or more can completely wipe them out. And then what? Then they're restarting and having to go save all that money again or work for another 20 years to build up that equity to try and do it over again. And that's, time is not on your side when those things start to happen. So I think it's just a lack of preparation and a lack of investing into the knowledge of what you're getting yourself into that gets most people in trouble.
Yeah, I can tell you from my point of view, I dumped everything into my business when I first started when I was like 26. It was I just didn't know what I didn't know. I sold all my retirement accounts, dumped all my cash into a business that I'm not going to pay myself, and I'll just take that. I'll just keep dumping into it, and for 3 years, I just literally dumped money, and I say that I didn't really start learning how to operate a business until I ran out of money and then racked up $98,000 worth of credit card debt. Like that's when things really started to become a learning process. So I learned the hard way, unfortunately. What would you say is like what paths do you help your students with? Do you mostly find your students are like W-2 people and you're working with them to help create that game plan to get to financial freedom? Or are they, full-time entrepreneurs and you're having to like wrangle them in to figure out how to create something that they don't end up destroying through their entrepreneur ADHD?
Well, you're speaking my language now because I'm definitely belong in the latter group. But before I answer that question, which I will, I just want to anchor in the fact that I'm in the same boat. And I'm not at the top of the mountain. I'm not flying around in my PJ. I'm not a billionaire status and fund manager. I've been in the trenches building businesses and doing real estate and having my own wins and having my own failures. And so in the same boat as, we're always investing. We're always putting everything on the table. As an entrepreneur, business owner, there isn't really any other option. We believe in ourselves. We invest in ourselves. And so, I've taken my punches too. And I know I can appreciate what got you to where you are going through the same thing. The thing that I say, or that I see most of the clients, they're kind of all over the place. And I deal with people that are getting paychecks that are working 40 hours a week, just wondering what to do with their spare change or potentially their home equity. I see business owners that are still grinding and still working and have lots of capital that they're looking to make a decision. Everybody says, maybe put it into real estate. Well, what does that mean? And then there's entrepreneurs, which are typically the ones that are more on the operator side. Those are the ones that want to be in the business. They want to be doing what I'm doing. They want to be raising the capital and getting a lot more active. But in general, what I see as a common theme between all of them is just a real lack of understanding of what it actually takes to do this business. And that goes back to the first question. But I would say there's an even spread of people. One's people realize how much work it actually takes to do this business correctly, then I think they become a lot more aware of how valuable investing their money into good operators is. So there's a real key piece of awareness there. Everybody wants to do it themselves. Everybody thinks that it's easy. You're just going to set it and forget it. That's not the reality. You and I both know that, and operators know that. People that have been burned know that. They know that it's, not all roses. So everybody wants to know how to do it, and I think that's what Arms and Prepares. That's where I come from on the training side of it. Is that I want to help everybody as much as I can understand the actual inner workings of a deal to help assess risk, to not look at the most optimistic projections, but look at protecting their downside, no matter where they're coming from, so that they can protect their time and their money on whatever they're investing into.
Yeah, and it's not just deal specific. It's like what you're doing in your personal finances as well. Like it took me way too many years because I kept going all in on my business, all in on my business, all in on my business. And it took me a while to realize like I still needed to keep some of those W-2 principles that I had, which was, I lived really well below my means. I was still doing that. But I was dumping money into investments, right? And those investments were appreciating, they're paying me money. And so I did a good job when I was doing that W-2 because I had that stability. But when you remove that stability, that W-2 job to go on all in the entrepreneurship, after 6.5 years, I was like, I'm dumping everything into the business, and the business is growing, it's doing well, and but then we had the 2022 event happen with interest rates, and I was like, holy crap, you're just one event away from losing everything, and it can be completely not you. You can have the best real estate deal in the world, you can, have high integrity, do everything right, and the market's still gonna chew you up and spit you out, eventually. So you got to kind of prepare for that rainy day. You still need to be dumping some money into the side to prepare. So how do you advise like clients? What does like the first step look like when you're sitting down with somebody and you are trying to come up with a game plan to help them get to where they want to go?
Well, to your point about not having, everything blowing up, tuning and spitting it out, that's actually why I got out of my business. Like I founded a welding and construction company in Vancouver, British Columbia, when I was a young business guy myself, and the same thing sort of happened to me, except it was a partnership. I had partnerships, and I had a big partnership completely blow up. And I took a look at myself, and I'm like, what am I doing this for? Like I'm putting all this time, all this energy, sacrificing my time with my kids, all the same thing all of us do every single day, only to have something happen in the business for me to hand them something that they have to actually step into to operate just like I did. Like that's not going to work. Or I have a partnership go sideways and that blows the whole thing up. And I've always been into real estate for most of my life, but that's where it really anchored in for me. It really hit home that the time and energy that you spend, if you spend it well in real estate, you do the work once and then it pays you for the rest of your life. Now, again, if done correctly. And so to your question about how I approach every client, the one thing that I can't stand, and I know we're aligned on this as well because we talked about it, is trying to sell information to anybody who's willing to buy it that is sort of this one size fits all.
So you're advising an entrepreneur in this case, not a W-2.
Okay, so if I was advising an entrepreneur on going into this business, we're talking about like getting into the real estate on the operational side.
Well, no, just like if you're sitting down with a client that you're trying to build the blueprint to financial freedom, because I know that's what you guys do at the real estate, ultimate real estate lifestyle. Like, what's the first step that you take in that process?
Okay, so the first step that I take is to get rid of that one size fits all mentality right off the bat. One size does not fit all. What actually matters the most is the only way for me to actually give someone good advice. And that's what people look to me for. Like, help me make a decision. Don't just give me the video and tell me to go do it myself. Help me in real time. There's no possible way that I can help anybody do anything, make any decision, if they don't understand, first of all, where they're at and where they're trying to go. I do this onboarding process called, and that sounds generic, but it's not, because to help build people a plan, you have to have a clear understanding of what that is. So the where you're at is the 5-pillar intake that I call the investor identity, or internally in our course, we call it the investor passport, because you need a passport to travel. So the very first thing I look at is how much capital do you have? Like, what is the money that you have that you're willing and able to invest? What is the experience that you have? Have you ever done this before? Have you ever done a renovation? Have you ever bought real estate? Do you own your house? Are you in residential? Have you ever done multifamily? What is your experience? Then it's what is your capacity? How much time do you actually have to spend on the real estate? Now, whether you're an operator or an investor, you still have to spend time. You have to spend time doing due diligence. You have to spend time looking for the right deal. You have to spend time actually going to give your money to someone and then to be able to stay involved in that, no matter what that is. The other one is what is the role that you want to play? Like, do you want to be completely passive? Do you want to give somebody else the reins and give them access to your money to do with as they please? Or do you want to be actively involved in the deal? Do you want to be a partner? Do you want to bring on partners? Do you want to raise capital? All of those things. And then the other one is how long till you get the result. So that's the last thing. What's the time frame here? Are you looking to double your money in the next year? Or is this a generational build for you and your family where there's a lot more patience involved? So once somebody is able to answer, once we dig into those 5 things, that clearly defines what they should and what they should not be looking at. So that's an easy filter to stay away from 99% of the things that are just shiny objects and distractions that are not going to get them anywhere closer to where they want to be. Mm-hmm. And that's really the basis from there. Because what I tell somebody with $50,000 on their line of credit compared to somebody who has $2 million of liquid cash sitting in their company, those are 2 completely different paths of somebody. Yeah. Now they both start with education, educating yourself. You absolutely have to understand what it is that you're getting yourself into. I don't care if it's 50 grand or if it's 2 million. They're both just as important. In fact, the guy with 50 grand is probably even more important because that's going to make or break the outcome. The other 2 million, well, who knows? But knowing where they're at is the first stage, and then it's like, okay, how fast do you want to go? Are you a high risk, high reward playing with your money and just, getting those bigger returns, but also understanding that you're taking a lot more risk? Well, let's go leverage the crap out of a value add deal that we're going to spend 2 years of our life doing. And, when everything goes right, you're going to double or triple your money. But there's a lot of risk associated with that some people have to be able to stomach. And if you're on the boat,
so the average person that I meet with that books a call with HBG Capital and they want to learn more about our opportunities, they are in their 50s. They're putting their last kid through college. They typically have not done what they should have done in the past and, prepared more. And so they're like, we need to play catch up for retirement. They're semi burned out or completely burned out in their job. They need to make about $20,000 per month in passive income. And they typically have about 7 figures of net worth, at least, if not a little bit more, that they're working with. And they typically have a few $100,000 of liquid capital that they're looking to invest. And that's usually come from converting one of their current IRAs or old 401ks into a self-directed account that they can then use to invest in real estate. And, they're looking to get there in a 10 year-ish period. Let's have that be the baseline. And I'm that person. What's step 2 then look like?
So that's a good perspective because it's a lot of people, because $20,000 a month is a lot, but it's where a lot of people want to get to. So having a 10-year runway would be important because you said a couple of things there. Number one, you said that their net worth was about $1 million to $2 million, but that their liquid capital was kind of a few $100,000. And that's very typical because people have all their equity locked up in their home, right? Or their real estate that they can't necessarily unlock, or if they do, there's a cost to it, versus the actual liquid capital. It's very, very standard to be able to get a 10% cash on cash return for anybody that does a half decent job of vetting the deals that they're getting into. Let's just take that as the baseline. I know that may or may not be in someone's reality, but let's just call that the baseline. Well, with 200 to 300 grand of liquid capital, that's only 20 to 30 grand per year. In order for somebody to get 250 grand of passive income at 10%, they would need to be investing $2.5 million. So if the goal was to get that to that place in 10 years, you're going to have to take a blend of that liquid capital. Now, for someone to take 250 grand and turn that into 2.5 million over a 10-year period, that's 10xing over a 10-year period. That is not your typical return on a standard multifamily deal, any investment deal for that matter. Typically, retail investors are going to see about a 10 to 15% return year over year if they're invested into an asset that's paying down and appreciating over a 10-year period. So
Typically, they've got a few hundred grand like liquid they want to place, but they've got 7 figures worth of investments, not including their home. That's what I see. So they
you
have
would
other
be
investments. So it's usually $1 to $2 million in a mix of investments, right? Some rental properties or equity, rental properties, or we've got the 300 grand cash. We covered that, stocks, and stuff like that. That kind of the usual suspects.
I would be looking if I was trying to get someone there in a 10-year period and they had a stomach for some level of risk. They're not super downside protected, like, safe zone. I would take half of that money and I would invest it into something that was very low downside protected kind of scenario where they are getting that 8 to 10% cash on cash return, because that's going to likely be in an asset where they're going to pay down and appreciate. The key to that is that you have to be in on the ownership side, because investing into most investments where you're just getting the 8 to 10%, you don't get that appreciation and pay down. You're just getting paid a dividend without that extra juice. So investing into something with a piece of ownership into a stabilized asset that has a good long-term projection, short-term and long-term, then the other half of that money, I would be looking at bigger plays, forced appreciation plays where you can actually invest into things that are depreciated or distressed with a strong operator that's got a good track record that can actually then start to get you those 15 to 20+% annual returns through those value add strategies. And that's risk assessment though, because some people can't stomach that stuff, but that way you're getting you're protecting your downside with having a good chunk of your equity into something that's paying you now and appreciating over time. And then the other stuff is the stuff that's actually going to get you to that doubling or tripling your equity in a 10-year period to, again, get back to that $2.5 million number, so that when you are retired, you don't have to take those risks anymore. Then that money, you can then set it and forget it at your 10% annual return and hit that $20,000 number. But there's a mix. To most people, there's a mix between playing safe with half of your money into something that is protected and predictable. And then the other one is you got to know how to find those good opportunities. And that's where most people get into trouble, because most of those good opportunities all look good on paper. Everything does. You never seen a performer that doesn't work. But once you understand the strategy of commercial investing, and I know you're into land development, I'm into multifamily, but there's mobile home parks, there's malls, there's hotels. All of it is commercial real estate that is based on the values based on the income it generates. So finding depreciated, knowing what makes a good deal, a deal is half the battle. And then finding the right people to invest into that are doing it well, that's the other half. And that's mainly what I teach people to do.
Tell me more about that last half.
The last half. The last half of the capital being invested.
You said that's what you teach people to do. You said the other half.
Yeah. So everybody asks me, do you only teach people how to invest, like how to be the operator, or do you teach people how to invest? Because I get a lot of people that come to me with capital in a similar situation as you. I don't want to learn how to do deals. I don't need to know that. I just need to know where to put my money. My answer to most people is, I'm sorry, but they're the same thing. The only difference is that when you have that knowledge and when you have that understanding, you either choose to do it yourself or you choose to invest into other people. And that's a very, very difficult thing to understand. It's very, very hard to trust somebody else with your money and do that confidently and sleep well at night if you don't understand what's actually going on behind the curtains. Because that's where most people fail, is back to what you see as most people fail, people that are investing their money, it wasn't that it was the wrong investment. It was that they just didn't do the right work at the beginning or know how to do it to make sure that that deal aligned with the risk versus reward scenario that they're getting into. And so understanding what makes a deal a good deal is the whole basis of real estate investing, is the whole basis of investing your money, period. And when people don't know what a return on investment is or how to calculate it, or how much money they're going to make on something or projected to make when they invest their money into something, that goes back to the first question you asked me about, well, what do you tell scenario A when they come in with this amount of money? Most people think, well, I just want to double this money and I want to be retired in 10 years. So investing into real estate, I heard, was the right thing to do. I'm just going to go ahead and do that. Well, you can go backwards by 10 years just as quickly, a lot quicker than you can go forward 10 years. And so that part of teaching people and educating them is my passion. I want to educate as many people in this world that I possibly can, to give them the knowledge to at least have confidence in the decision that they're making. That's what I truly care about most. Anybody that comes into my world, if I do nothing else other than to give them the confidence to quickly evaluate a scenario, an investment, to quickly determine whether it's a good deal or not, that is the most value that I could possibly give to someone. Then if they want to learn how to do it themselves, or they want to learn how to go find the right people to invest into, there's lots of avenues, lots of places for us to go. But
it's interesting. One of the biggest things, and again, since 2022, the interest rate rise, I've learned so many lessons from that. One of the things I've really paid attention to is risk. You didn't really need to before that. Oh my gosh, you could be an idiot and make money when the market's going up crazy like that. Holy cow. And since then, we've just completely shifted our focus. We're not trying to get the cheapest rates. We're trying to get the terms that we need on the products that we want to deliver to the market, right? I'll pay a higher rate, but if I can get my terms, the time I need, extra time I need to do it, not have any recurring payments, throughout the life of the loan, terms are so much better than that. So I say that because it's risk related. I look at every deal now through a lens of, what is the risk? What can go wrong? How do we mitigate those risks?
Absolutely.
And I think that's what's missing from what a lot of people got hit with. And this has been a lot of, distress and all the bridge loan stuff it's still coming out just to this day. Everybody that got stuck in the bridge loan, multifamily debacle when rates went up, is they didn't know how to price in risk into things. They just saw the return. So I'm kind of curious, how do you evaluate and price in risk when you're advising clients?
You nailed a couple of things there, because one of my mentors back in the day, they always said when we were like chasing rates, and he's laughing at one of the conferences we were at, because he just said, you guys are asking me questions, getting so focused on the details of like a 1% this way and 1% that way. He's like, I don't lock in for less than 10 years on anything because it helps me sleep at night. I don't care if the interest rates drop 4 points after I lock it in. It doesn't bother me at all, because I've been there when the interest rates doubled overnight and I wasn't sleeping at night. So to your point, I look at everything the same way as well. I spent most of my years as an entrepreneur looking at how I can make things work. What can I do to make this better? A little point here, a little point there, a little bit more bump on the rent, a little bit this, a little bit that. Now my lens is very much like yours. How do I kill this deal? How do I make it so obvious that I don't need to put money into this deal, that I can stop spending time on it? And so back to how do I assess risk? Risk for me is a lot different than a lot of people. And again, it's where you're at, where you're trying to go. Someone says you want to double your money, they want to double their money in the next 12 to 24 months. I'm going to tell them that every situation that they're going to step into is going to be risky. There's not a lot of downside that you can protect. You can do a lot of things, but there's going to be a lot of things that can affect you that you just can't control. And that's a risk that you have to be okay with if you want to try and get aggressive and doubling your money. If you're somebody that doesn't want to take that risk and you're happy getting 6 to 8% return, well, that's a lot easier to protect, because now you lock that into a 30-year loan that isn't going to change. in a market that has your downside protected, that shows growth, and you don't have a mortgage that is hairlining your investment every single month, and that one or two vacancies is going to mean the difference between you making money or you writing a check, that's how you protect that risk. Now, how you protect risk on the riskier side, this is a question that we're facing every single day, because me, on the value add deals that we do, it always requires bridge loans. You are buying something that is distressed, that is way undervalued, but there's a period of time that you have to go through, which is called your stabilization period, when you're doing the work. And that's not typically done with long-term debt. And so the risk that I'm looking at these days is being a lot heavier on the capital injection. So me, I'm scared of, my fear in the market right now is that we're nowhere near the end of the down cycle. I think we've got a lot of debt that's maturing. I think there's a lot of fracturing in the financial market. I think there's a lot of risk that people don't see. I think there's a lot of hype in thinking that this is coming back. And I think people are going to be unpleasantly surprised with black swan events that are going to impact their lending or availability or accessibility to cash with the banks. So for me, as somebody that's going in to buy these assets that are distressed, even though they have tremendous upside, you're going to be paying high interest debt along the way on the construction and renovation. And then there's going to be a period of time that you have to refinance that asset and pay off that temporary loan, because the building just will not sustain that high interest loan. Case in point, everybody that's trapped in the market right now renewing at 2 to 3 times the rates that they got in 2021. And so the only way to protect yourself in that scenario is to have more cash in the deal, to have strong capital partners that can write a check to solve a problem. So you're either buying it all cash while you do the stabilization, so that when you're done, you can very likely have a scenario where you can pull all that money out, and that's a big win. That's a tremendous deal. A grand slam deal to us is your acquisition cost plus your renovation cost is no more than 75% of the future value. Then you refinance, and that 75% comes out. You've got all your cash to play with again, and you own the asset when you're done. That's the dream deal. That's what everybody wants to do, and that's what distressed value add properties do. But to de-risk that, Brandon, we're talking about more cash. I want strong cash partners that do not have a liquidity problem, and that can either come in cash throughout the entire deal, or they can write a check to solve that problem. Because 50% of the deals that I was in over the past 5 years shouldn't say 50%. I would say that 30% of the deals that I was in had capital partners that did not have the ability to write a check to solve any problem. Not a $5,000 problem, not a $500,000 problem. And those are the developments and those are the projects that just couldn't make it through the tough times. And it was only the ones that I had partners that could write a check to solve the problem. Even though I had to step out on deals, hand over my equity, the point is that I had partners that could step in and solve the problem so that the market didn't take them out. And it took that to solve a lot of problems. So now when I step in, I'm not even raising capital actively in most of my deals, because most of the people that are looking to get into the deals are writing their $50,000, $100,000, $200,000 checks off their line of credit or their last little investment. And some of the stuff that I do is too risky. Great upside, but it's just not for them. But then you go to put them in stable deals, and then most of the people are disappointed that they're only going to get 6 to 8%. It's like, well, you know what? That 6 to 8% is still going to be there at the end of the day, and you're not going to lose that money that you have invested. You don't need to take that risk. So yeah, different lens, different perspective. But for me, to answer your question in a very simple form, we're looking to just put more cash in during the stabilization period and not over leverage, so we don't get pinched like everybody just did in the last few years.
I love it, man. I love it. These are words of wisdom. I know we're kind of coming up on time right now. So if people want to learn more about you, learn more about top-down investments, or learn more about your consulting program for financial independence, where can they go?
You can go to the Ultimate Real Estate Lifestyle. It's ultimaterealestatelifestyle.com. I'm hosting events every week or two that are sharing everything that I'm doing. It's sharing knowledge and putting information in people's hands and seeing who's a fit that wants to go into the coaching and training program. Top Down Investments is my acquisition company, topdowninvestments.com. Although, like I said, not very active in raising capital. We're being very careful who we're partnering with these days. So either of those are going to get you great information. You can get a hold of me anyway. You can also check out the YouTube channel, Ultimate Real Estate Lifestyle, as well.
Go check that out, Ultimate Real Estate Lifestyle. Guy, it's been an absolute pleasure. Thanks for coming on the show. If you know somebody who this would benefit, if you found value and think, you know what, this person might find this helpful, share this episode with them, and we will see you guys next time.
Appreciate it, Brandon. Take care.